Good morning or afternoon, depending on where you are in the United States. My name is Christopher Friedman. I'm an attorney and a partner at Husch Blackwell. And I am so glad you've decided to join us for our conversation about Dodd-Frank Section 1071. Like I said, my name is Chris. I head up our alternative commercial finance team. Our team works with fintech-based small to medium-sized enterprise lenders, commercial factors, supply chain finance companies, and other commercial finance companies to provide legal advice related to regulatory matters, licensing, and really all other legal issues related to the industry. I'm here with two of my colleagues who I will introduce. Alex McFall is a senior counsel also here in Nashville, Tennessee. She works heavily on licensing and disclosure issues in the commercial finance space, as well as regulatory and compliance and litigation for both consumer and small to medium-sized business lenders and finance companies. And then finally, my law partner, Leslie Sowers, is in our Washington, D.C. office. Leslie has extensive experience advising clients on the Home Mortgage Disclosure Act, which is the equivalent regulation that applies to residential mortgage lenders. If you've heard me talk about 1071 before, you've heard me say that Section 1071 is the Home Mortgage Disclosure Act, but for small business lenders. And that's one advantage that folks have when working to comply with 1071 is that folks in the mortgage space have been dealing with an equivalent regulation. So there is a lot of experience in that space and folks that have been dealing with it for a long time. And Leslie is one of those people. So today what we're going to do is discuss Section 1071 broadly, but also with a special focus on alternative finance products. But before we begin, what I want to do is really situate Section 1071 in the broader landscape of regulatory growth in the SME finance space. Really, over the last 10 years, there's been a presupposition by regulators and lawmakers that small and medium-sized business owners are sophisticated counterparties that don't need the type of protection that consumers oftentimes get. That presupposition really has eroded. Lawmakers and regulators now work under a new assumption, right? That small to medium-sized business owners need consumer-style protection and regulation. And there are a lot of examples of that we're really seeing a lot of really over the last few years. First and foremost is state TILA-style disclosure laws that are widely proliferating. If you do business in California or New York, or in some of the other states that have these types of laws, you know what we're talking about. You are having to apply APRs to products, sometimes products like factoring products where it's very difficult to actually utilize an APR. There are also registration and licensing requirements that are proliferating. If you're in Utah, you know that there is a registration requirement for certain small business finance companies. If you're in Missouri, there's a new law that just passed a few weeks ago that requires a commercial finance disclosure, but also there is a broker registration requirement. So what we are seeing is this proliferation of regulation in the space. Now, Dodd-Frank 1071 is part of that proliferation. However, it goes all the way back to 2010 with the Dodd-Frank Act. However, it's really only now going into effect, in part because when the Dodd-Frank Act passed, really the focus was on the mortgage industry and on other types of credit products, consumer credit products, not commercial credit products. And in part because of that presupposition that I was just talking about, right? It really wasn't until right before COVID a consumer, and I say consumer, I know we're talking about commercial lenders, but a kind of consumer group sued the CFPB saying that, look, it's been X many years. It's time to come up with a final rule on 1071, and the Kraninger CFPB kind of launched the effort to proliferate a final rule. what I think it's going to require is a cultural shift by commercial lenders. I think this is a broad kind of global thing, but I think it's important to understand as we get into a conversation about 1071. And what does that cultural shift, what does it kind of comprise? Well, first of all, you have to keep in mind that the commercial lending space is very different than the consumer lending space. It's not traditionally regulated. It's very much a relationship business, and credit decisions are often made based on judgments that are not easily quantifiable, right? Certainly, if you're in a small community bank, it's those face-to-face relationships that oftentimes drive underwriting decisions. But given the new regulatory environment, that practice, that relationship-based practice, carries with it a great deal of risk. And the key for successful finance companies is going to be finding a way to balance and preserve the essence of the commercial lending model with this new regulatory reality. So our goal today is to really open a conversation by describing what 1071 is, how it applies to the industry, and then to provide some initial thoughts about two things. First of all, how to make compliance processes as painless as possible. And then second, how to maintain the essence of your business while reducing that back-end fair lending risk. Because when we talk about 1071, what we're talking about is ultimately fair lending and a tool that regulators have to enforce the fair lending laws. So with that being said, I am going to send it over to my colleague, Alex McFall, to talk about, well, what is Section 1071? So Alex, take it away.
Thanks, Chris, and thanks everyone for being with us today. So really broadly speaking, Section 1071 is a data collection and reporting regime for credit application data. And what it does is it requires financial institutions to collect and report data on their small business lending. And the primary goal here under 1071 is to determine if the applicant is woman-owned, minority-owned, or small business. So more specifically, what it requires is for financing providers to gather specific data points for each small business loan application. That includes information about the business's ownership, the loan amount, and the credit decision. This data is then submitted to the Consumer Financial Protection Bureau, or as you'll hear us refer to them, the CFPB, which uses it really to analyze trends, to monitor compliance, and to enforce fair lending laws. So in the eyes of the CFPB, the ultimate aim here is to increase transparency in small business lending, to promote equal access to credit, and to really ensure that underserved communities are supported when it comes to small business lending. The data collection requirements sort of attach to what's called a covered application. And Chris is going to get into a little more detail about what is considered a covered application in just a few minutes. And just to address the barging, we all have pets that are very eager to join this presentation. So if anyone sees any cross the screen or jump in our laps, just know that we have tried our best to wrangle them, but they may still get on your screen. So there are, as you can see here, there are a lot of data points to collect here. And again, you can see that some come from the applicant, some relate to demographic information, and some are data points that are generated by the specific covered financial institution. There are a lot of scenarios where other data points are triggered. For example, if applications are denied, there can be additional data points that are required. One specifically noted here is a data point concerning the reason for the denial. And something that makes sort of all of this data collection really tricky is that applicants can refuse to answer questions about whether the business is minority owned or women owned or LGBTQ plus owned. And if that were to happen, obviously you can note that in your data. But the one thing I want to note just on that point is you cannot discourage an applicant from supplying that information. But again, you can note it if for some reason they do decline to provide that information. I also want to just touch on a few of relevant defined terms here that have been mentioned in the slide. A business is minority owned if one or more minority individuals holds more than 50% of its ownership or control, and for which more than 50% of net profits or losses accrue to one or more such individuals. So I know that's kind of a lot to take in. And if ever you kind of want these in writing or want to talk about these in more detail, we are always available to chat. But in that same vein, a women-owned business is one where more than 50% of its ownership or control is held by one or more women, and more than 50% of its net profit or losses accrue to one or more women. And you hear a lot of this talk about principal owners. Just really quickly, a principal owner is an individual who directly owns 25% or more of the equity interests of a business. So again, the data provided to the CFPB is going to be made publicly available through the CFPB's website. That goes in a loan application register. And it's going to be reported to the CFPB by June 1st of kind of the following year compliance date. The CFPB says that this effort is going to, and it will, result in the creation of the first comprehensive public database on small business financing practices. Now, let me tell you why that is a little bit terrifying. And by a little bit, I mean a lot of it terrifying. Chris mentioned earlier how the Home Mortgage Disclosure Act, which we call HMDA, is sort of the 1071 equivalent on the consumer finance side. So, some of you may not follow consumer finance news very closely, so I'm just going to tell you a little bit about this kind of horror story or example that we sort of use. But it involved Navy Federal Credit Union. So when you're submitting this enormous amount of data to a publicly available database, obviously it's not just the CFPB who's going to have access to that data. So in the case of Navy Federal Credit Union, they're going about their business, their HMDA data is out there in the world, and suddenly CNN releases this incredibly detailed investigative report that essentially reveals that Navy Federal Credit Union had the widest disparity in mortgage approval rates between white and black borrowers of any major lender. So obviously this was huge news. There were so many follow-up stories that came from that. The fallout has been, it's significant, almost feels like an understatement. There's been congressional scrutiny, regulator scrutiny, lawsuits, multiple class actions. They have just really been trying to deal with the fallout from this report since it was released. So I just want to emphasize kind of how seriously you should take this, the fact that your data is going to kind of be out there for anyone to look at. And one point we always like to make to folks is the fact that this data is going to be kept in this sort of database really gives regulators another ally, which is the media. Which, as you can see from this, is always a lot of fun to get them involved. Just one more thing to note really quickly before we move on. There's a requirement that you maintain your lending application registers and other evidence of compliance for 3 years after that data is due to the CFPB. So you just want to be mindful of those retention requirements as well.
So why does 1071 matter? And Alex kind of previewed this earlier, but I want to get a little bit more granular as to what exactly are the regulators and lawmakers trying to accomplish here. And I think it starts with the Equal Credit Opportunity Act. ECOA has always applied to commercial purpose credit. And if you look at the quote that I've included on this slide, that is from the Equal Credit Opportunity Act, and that is this sentence is the gravamen of the Equal Credit Opportunity Act. It's unlawful for any creditor to discriminate against any applicant with respect to any aspect of a credit transaction on the basis of an ECOA protected characteristic. Any creditor and any applicant. It does not distinguish between commercial and consumer. Now, again, like I said before, while ECOA is applicable to commercial credit, it hasn't found much purchase in the commercial space, in part because, like I said before, there's just has not been that much of an effort to apply these types of laws to those types of products. 1071, however, will make it easier to bring ECOA claims by providing this tool of data. So the question is why? does this data make it easier to bring discrimination claims? And I think it comes down to a very specific type of discrimination that is prohibited under ACOA. Now, under ACOA, there are three primary theories of discrimination. There's overt discrimination, and that's one example of this is that, if a lender offers a revolving loan of $50,000 with a $50,000 credit limit to applicants aged 21 to 30, but a revolving loan with a $100,000 credit limit to applicants over 30. That's arguably age discrimination under ACOA. You are providing different products, one with a higher credit limit and one with a lower credit limit based on age. And age is a protected characteristic. So it is overt. It relies on that protected characteristic. Then there's disparate treatment. And a good example of disparate treatment discrimination is that, like, let's say a non-minority applies for a loan, but the lender finds adverse information in the credit report. The lender gives the non-minority an opportunity to explain, and after the explanation, the lender approves the loan. The next day, a minority applies for the exact same loan, and that minority has the exact same creditworthiness characteristics, but the lender finds the exact same type of adverse information in the credit report. Well, that lender on the next day immediately issues a denial. So you see that there's no specific, the discrimination isn't expressly based on race. However, the way that the two different similarly situated people were treated was different based on the race of those persons. So, and those two types of discrimination have been widely litigated. And primarily by private litigants, although there have been many regulatory actions brought. But what we do see a lot of is claims brought based on this third type of discrimination, which does not require any type of intent. It's just based on the outcome of the credit decision. And that is called disparate impact discrimination. And that type of discrimination is heavily based on data. So let me explain a little bit further. Disparate impact discrimination, let me give you an example. Let's say a lender has a policy not to offer loans for single family residences of less than $60,000. Over the course of time, that minimum loan amount, which is totally neutral on its face, right? That policy has nothing to do with any protected characteristic, but it might disproportionately exclude members of certain protected classes based on disparities in income level or the value of houses in certain areas. So you look at, well, what is it, disparate impact? It's, you could have a facially neutral policy or practice, but if it disproportionately impacts negatively a protected group, that is a violation of ACOA. And you can see why this theory of discrimination is so powerful for regulators and litigants. It's that intent doesn't matter. You might have all the great intent in the world, but the litigant or regulator doesn't have to prove up your intent. All they have to show is the disparity. Well, the thing is, that theory of discrimination is very data intensive. You have to establish a disparity that affects a statistically significant slice of your applicant pool. So what that means is that you have to look at a really large number of loans and applications from both protected and non-protected classes. And in addition, the disparate impact theory doesn't only rely on denials and approvals, right? You can prove up a disparate impact claim based on a lot of different outcomes. For instance, loan pricing, loan amount, the term of the loan, the number of counter offers versus full approvals, the amount of fees, and et cetera, and et cetera. If you have a disparity and the non-protected class is being treated more favorably than the protected class, then you have a prima facie case of disparate impact discrimination. And it's really difficult, if not impossible, to make out the disparate impact claim without this type of data. So right now, the only type of loans that are sitting out there where this type of data is highly available is mortgage loans. Like I said, I've got my law partner, Leslie, on, and she deals with this law all the time with regard to mortgage loans. But the reason that is because of the Home Mortgage Disclosure Act and Regulation C have been around for a while. And those are the regulations upon which 1071 is effectively modeled. So now, that doesn't mean that the CFPB hasn't in the past tried to approximate this type of data. And a good example of that is in the auto industry and like between 2013 and 2014, when the CFPB was utilizing what it called proxy data to approximate this type of data. So they were using surnames and geographic locations of people to draw conclusions about disparities. Unsurprisingly, that faced significant blowback and challenges. There was litigation, or the CFPB was challenged on this, and also there were lots of studies showing that the proxy data wasn't accurate. So bottom line is that 1071 gives regulators and litigants all this data necessary to establish the disparate impact claim, and it's publicly available. You can throw the data. You can go on the FFIEC's website today and pull a bank's HMDA data and drop it into a spreadsheet or a data program and run regression analysis and create all sorts of different disparities. It's not that hard to show a disparity based on something. So that's why it's risky. That's why it's important. And that's why you need to be paying attention to it. So Leslie, I'm going to throw it over to you to talk about, well, who exactly is covered?
Well, thanks, Chris. In order to answer this question, we really need to understand the key terms that are here on the slide. We're going to consider each one at a general rule level, and then we'll go into more detail on certain exemptions and exceptions. So first, the most important one here is a covered financial institution. As the name denotes, it's who is covered by this rule. And it's any entity engaging in financial activity who has originated at least 100 covered credit transactions in each of the preceding 2 years. So what this means is if you originate, for example, 80 credit transactions that are covered in 2025 and then 118 in 2026, you are not covered in 2027. And that's because it matters that you hit the threshold in both of the 2 preceding years. However, if in 2027 you originate 120 covered transactions, then you'll be covered starting in 2028. And you'll have to start collecting information on applications and originations as of January 1st of 2028, and then report that data by June 1st of 2029. So it can fluctuate. If you're right on the edge, you may be covered one year and not covered the next year. But for most people who are originating above this threshold on a regular basis, once you're covered, you're covered. So second, we'll talk about what is a covered credit transaction. And that's an extension of business credit and as that's defined under Reg B. And it's the business credit that has to be made to a small business. So it's not just all business credit, but it's one. And what else is excluded here that you don't have to worry about transactions that extend, renew, or otherwise amending an existing transaction for this purpose, unless the request is seeking additional credit amounts or is a fundamental refinance. So for purposes of coverage, you only count covered originations. So those are, we don't worry about applications in the context of coverage, but you will be once you're covered, you will be reporting covered applications. So let's talk about those. And a covered application is any oral or written request for a covered credit transaction from a small business made in accordance with the procedures used by your institution for the type of credit requested. And so financial institutions generally have a lot of latitude here to establish its own procedures, application procedures, and define what they call an application. But you need to be very, very careful here because the term procedures doesn't just include what you have written down in a policy or a procedure, but it also includes your actual practices. So if you have loan officers doing things that are not in your written policy, and that should be an application, then those would be applications for purposes of this rule, and you should be reporting those. Those are things you're going to want to try to reconcile and get consistent and get controls over to ensure that you're reporting the actual applications based on your actual practices, which is easier, I would admit, in my experience from a mortgage perspective versus a commercial business perspective. It's not quite, the application process is not quite as defined in this world as it is in the mortgage world. So, but that is something that you want to get your hands around as soon as possible and make sure that you have that well defined and all of your staff knows what it is, because that will trigger what in fact is covered and what is not. And so to be covered, all of these applications have to be, again, from a small business and be for a covered credit transaction. And what is a small business? So generally, it's defined in the same way that the small business concern is defined in the Small Business Administration's regulations, but excluding the size standards in those regulations. The CFPB decided that they would make it easy on everybody and do a gross annual revenue of $5 million or less of the previous year as the standard of small. Now that amount can change every 5 years. But for now, we have a $5 million or less gross annual revenue. Now, this can be, you can rely on a stated amount in the application at first. If you find out through verification or the application process that is a different amount, then you will need to rely on the verified or otherwise discovered amount. So, a small business can also be, it has to be a for-profit business. It can be any form like a corporation, a partnership, an LLC, sole proprietorship, association, trusts, or cooperatives. So it can be any form. It can even be a joint venture, but here, if it's a joint venture, it can have no more than 49% participation from a foreign business. And this comes from the small business application regs again. And then, so that basically you would be excluding all nonprofit organizations from this definition, as well as government entities. So what is covered? So if your company is now considered covered, you need to know what kind of applications and transactions are then that you need to actually report, collect information on and report. The covered credit transaction is very broadly defined, and it's basically any credit extended to a small business that would be also primarily used for a business, commercial, or agricultural purpose, unless expressly excluded, which Chris and Alex will go into a little bit more of that, those important exclusions here in a minute. But this includes all of these that are sitting here, that are listed here on the slide: closed-end loans, open-end lines of credit, business credit cards, merchant cash advances, and revenue-based financing. If, for example, you have a sole proprietor who has a business purpose, or says they have a business credit card, but sometimes use it for personal, that's when you need to apply the primary purpose test and determine whether the credit, the credit card is in fact primarily for a business purpose, or is it primarily for a consumer purpose? If it's primarily for a business purpose, it's covered here. But you may rely on an applicant's statement of the purpose for the credit requested in order to make that determination. Now that we know kind of the general scope of the transactions covered, I'm going to turn it back over to Chris to discuss some important exemptions.
Wonderful. Thank you, Leslie. So I'm going to talk about in detail about a few of the exemptions, and then maybe a little less detail about some other ones. And the ones I'm going to talk in detail about are some of those alternative products that we said we're going to kind of spend some time focusing on, because, in part, it's complicated. And certainly for folks in the factoring industry, and I know there are several of you on this call, factoring is excluded, right? And I think a lot of folks were really excited to see that factoring transactions were excluded. However, it's complicated, and I want to really spend some time going through some of the nuances. So first, like I said, there are a lot of factors on the call, but based on the attendee list, there are folks here who do not appear to be in the factoring industry. And I just want to kind of level set and explain, well, what it exactly is factoring. Well, first, it's not a loan. Factoring is the purchase and sale of a legally enforceable claim. And in particular, a business, let's say it's a widget manufacturer. Let's say the widget manufacturer sells widgets to the Acme Corporation. The manufacturer will invoice Acme on, say, a net 60 payment term. That manufacturer, though, might have cash flow needs and might elect to sell its account receivable to a third-party factoring company who will purchase that account for the value of the invoice minus a discount. The factoring company, in turn, will collect directly against Acme. The idea being that the factoring company will pay the manufacturer on a faster basis than net 60, but it will cost the manufacturing company a discount in order to get the money a little bit faster. So the idea there is that, again, you are purchasing an account receivable. It's not a credit transaction. You're not deferring the payment of a debt. 1071 provides a definition of a factoring transaction. And 1071 says, look, if you fit within these definitions, if the product fits within these definitions, then it's not considered a covered transaction under Section 1071. But it's not straightforward, in part because the definition of factoring is fairly narrow here, right? It's an accounts receivable purchase. You are selling a legally enforceable claim, and the name of the transaction is contemplated by the parties is not determinative. You can't call a credit transaction a factoring transaction between the two parties and have the CFPB count it as a factoring transaction. So let's talk a little bit about kind of what makes this definition narrow. And I really want to start with some good news, right? The regulation does not distinguish between recourse and non-recourse factoring. And that is good news, because the CFPB very well could have said that recourse factoring is credit and non-recourse factoring is not. And we know there are certain states that get a little funny about that. So it's nice to see the CFPB taking what I see as a pretty commonsensical approach here. So for you non-factors, well, what is the difference? Well, a recourse factor is seen as a factoring transaction that's a little more like a credit transaction, because under the terms of the factoring agreement, the factoring company has recourse against the seller of the account. So if the account debtor, in the example, my prior example, Acme, if they fail to pay, then the factor can force the manufacturer to repurchase the account. Under a recourse factoring agreement, the factor takes on less risk, right? Because they have that repurchase right. So fees and the discount are usually a little bit lower, and sometimes the underwriting standards are a little bit more relaxed. On the other hand, non-recourse factoring, or some people call it a true factoring transaction, the factor assumes the risk of non-payment and usually absorbs the loss should Acme fail to pay. So if Acme doesn't pay, the factor really has very few options by which it can force a repurchase. There's sometimes a few based on factors such as like fraud and that type of thing, but usually in a non-recourse factor, you're assuming the risk, so your discount's going to be bigger and your fees might be bigger, and the underwriting standards are going to be a little tighter. So but the rule, so that's the good news, right? We don't have to worry about whether or not you're recourse or non-recourse. But the rule, as well as the commentary and the preamble to the rule, substantially narrows the definition of factoring in a way that means that some products that factors oftentimes do offer could be covered under 1071. And because of that, factors have to be really careful to review and understand their product offerings to make sure that all their product offerings are excluded. And here's the key. Here's one key, like one thing I want you to take away if you're a factoring company. Because like I said before, companies in the commercial finance space, and really this doesn't just apply to factors, this applies to anyone in the commercial finance space. So I think this is really a key point for anybody. Because like I said before, you're in a space that is not highly regulated, and you might not have as robust a compliance management program in place as maybe a consumer lender. Although I do know that there are compliance programs out there there are factors out there that do have compliance management folks and folks that are experienced in compliance management. I think that's fantastic, but not all do. Here's the key: because you have this regulation in place that could apply to some of the products you might offer in the future, it's important that you have procedures in place that can catch that, right? Like you might say, hey, we're doing all just basic transportation factoring. We are not offering any add-on products. We're not offering any type of credit products. We just do straight up, purchase sale factoring, right? So we are not a 1071 covered. We're not offering 1071 covered products, and we don't have to worry about it. Well, what if in 2 years someone on the business side has a brilliant decision to offer something that is covered? How are you going to catch it, right? That's the key. How are you going to catch that product? So it's important that you have some structure in place to be able to catch that so you don't miss it by accident. So back to kind of the factoring piece, as you can see on the slide, there are really three primary requirements to being a factor and they cut kind of narrowly. First is that the right that is being purchased and sold has to actually exist at the time of the transaction. And when I say that, I mean when the funds are forwarded. I know that oftentimes in a factoring transaction, you'll enter into a master purchase agreement where you contemplate the purchase and sale of actual transactions that are happening in the future, right? That happens in transportation factoring and pretty much any other big factoring transaction. That's not what I mean when I say the time of the transaction. What I mean is when the actual purchase and sale occurs, the right actually has to exist at that time. And that's actually, there's a reason for that. If you're in the factoring industry, you probably don't love merchant cash advance, right? Well, I'll get to that in a second. I want to stay on this, and then I'll get to that point. So that's the first thing. The right must actually exist. Second, the factor has to seek payment directly from a third party. If you're seeking payment from the seller of the account receivable, then that's not going to be, that falls outside of the definition. And then the transaction between the recipient and the provider must be complete at the time of sale. There cannot be an additional or remaining debt that's created, right? There's no payment that's deferred. The transaction has to be complete. Now, again, that doesn't necessarily refer to repurchase obligations, because that right and obligation is conditional, right? It's not really accruing until later on, and something has to happen. So those are kind of the three requirements. So the question, though, of what is not excluded is a little bit more open-ended. They didn't catalog the type of common factoring transactions that might not constitute factoring for purposes of 1071, like the type of ancillary products that factors might offer that constitute credit. The CFPB, those products are subject to 1071. So it requires that we kind of think a little bit about, well, what are some products that factors oftentimes offer that could kind of fall outside that narrow definition? And here's kind of what we have come up with, right? I think the most obvious is fuel cards. In the transportation factoring and freight factoring space, factors often provide a fuel card that provides discounts at certain gas stations, et cetera. Oftentimes, they will provide credit against the carrier's accounts receivable. So if you have a fuel card program, you need to look at it and think about, well, how does the fuel card program operate? Who is the originator? Are we originating the credit? or is it someone else? And if it's someone else, like, there are lots of companies out there that do this, like Wex and Loves, I believe, and some other companies. Are they the originator and not you, right? Are you just kind of facilitating or brokering that transaction? And if that's the case, who actually bears the 1071 reporting requirement? Who is the covered entity? That's going to be fact specific. You've got to look at your agreements, and you've got to have conversations with your service providers who are helping you provide those fuel cards. And then you need to work with counsel to review your fuel card program to determine who should bear the reporting responsibility. The other product is these like advanced programs. Is the factor purchasing a then existing right, or is the factor purchasing a legal right that parties anticipate will be created in the future, right? If that factor is providing an advance, right? If they're providing a product that, or they're providing payment in exchange for a legal right that might in the future be created, then the CFPB is going to consider this to be a credit transaction, because the legal right that the factor is purchasing doesn't actually exist yet. And that kind of gets back to why I was talking about MCAs, right? Merchant cash advance, because this is kind of how the CFPB ultimately justified excluding merchant cash advances including merchant cash advances, but excluding factoring. So what's a merchant cash advance and how does it differ from factoring? Well, an MCA, or it's a lot of folks call it revenue-based finance now. That is the purchase of a future receipt rather than an existing account receivable. And a good example of this is, like, let's say you own a bakery, and that bakery needs cash but doesn't have really established credit. They might go to an MCA company and sell its interest in a finite amount of future receipts at a discount. And then what will happen is that the MCA company will collect on a certain percentage of that baker's future monthly receipts until the full amount is remitted. So it's kind of like a factoring agreement. And the MCA company will say, well, we are purchasing a legal right in money that will be paid to you in the future. But the CFPB says that this is credit notwithstanding the MCA's arguments, right? The MCA will say that this is not credit because it's, first of all, there's no recourse in bankruptcy. If you have a properly situated MCA agreement, there cannot be recourse in bankruptcy, and the MCA has to assume the risk of the business failing. There has to be a true-up mechanism so that if the business doesn't have income for a particular month, well, the MCA shouldn't be able to be paid because there are no existing receipts to purchase. And then there can be no term. So the MCA companies will say, look, this is why we're not credit. Well, the CFPB says, you know what? We're not going to get into that. We're just going to make the distinction based on existing legal interest versus future interest. So yes, we have this narrow definition, and that makes it a little bit tougher for factors, but for factors who don't love MCA companies, it actually kind of gave the CFPB a justification to make merchant cash advance companies report. And if you are on this call and you're a merchant cash advance company or a revenue-based finance company, you're going to have to report. So just the way it is. Sorry. And then some species of supply chain finance and reverse factoring. And I really want to get into this because I know a lot of factors do supply chain and reverse factoring. And it's very difficult to describe this product without a picture. So I have drawn a picture. And I know this picture is also complicated, but I am going to kind of talk through this. So reverse factoring at its core exists to help both large buyers of supplies who benefit from having a steady, predictable supply of goods and materials. And it also benefits the suppliers who rely on cash flow and might have less favorable credit than their buyers. A perfect example of this would be like a Walmart, right? Walmart is huge. It's been around forever. It goes gangbusters. It probably has really good credit, but they've got tons of suppliers who are small, right? And might have tight margins and not a lot of cash flow and not a lot of credit. So the idea is that you have your buyer, like your Walmart, helping its suppliers by letting its suppliers kind of piggyback off their good credit. and then in order to help the suppliers obtain better cash flow. So here's how it works. The buyer is going to purchase goods and services from a supplier, and you see that with the kind of brown line running from the supplier to the buyer. The supplier is also going to invoice the buyer on a specific tenor, say like net 60. That supplier is going to need cash to continue its operations and serve as a steady source of goods or services to its buyer. So what it could do, it could sell its account receivable to the factoring company, which is a normal factoring agreement. But it might not get favorable terms, right? Because the supplier has tight margins and it might be a bigger risk. So the buyer, knowing this, might elect to utilize its favorable creditworthiness in a way that helps its suppliers by working with supply chain finance companies. The buyer is going to submit the invoice to the supply chain finance company, and the supply chain finance company will probably will enter into a separate collateral agreement with the supplier to pay on an expedited basis at a discount. And the idea is that the discount's going to be much lower than if the buyer had worked with a separate factor, because the buyer, it's going to be less. The supplier's discount is going to be less than if it had worked with a separate finance company, because that buyer has a good credit and a pre-existing relationship with a supply chain finance company. So the idea is that the supply chain finance company knows that that buyer is ultimately going to pay it at net 60 days, the day that it was due to the supplier in the first place. So that's kind of how this works, right? It is literally reverse factoring, but the buyer is using its great credit to help its supplier out. So I do have a trivia question for everyone. And what's going to happen is I'm going to go to this trivia question and you're going to get to choose yes or no. So here's what I want to know. This arrangement here, right? So what I'm talking about is the arrangement between supply chain finance company and supplier. Is that a credit transaction that would be subject to 1071? And I'll give everyone a minute or so to answer the question. Is everyone able to answer? All right. So we got 100% yes, it is a credit transaction, and no one's saying no. Well, I hope I'm not wrong here, because I think that it is probably just a basic factoring transaction, right? Because when you look at this, what's happening? We have the finance company paying the supplier in a timeline less than the invoice tenor in exchange for a discount. Now, the key to this is looking at, well, what is the definition? Okay, I think actually this is a little bit closer. So about close to 50-50.
Here's why I bet we only have like one answer in so far. When you have 100%, it makes me wonder.
Yeah, so I might have gone too fast, but we're running on time, so I want to make sure we get through everything. I know. So here's why I think it's probably not. You look at the definition of credit under Regulation B. Credit means the right granted by a creditor to an applicant to defer payment of a debt, incur debt, and defer its payment, or purchase property or service and defer payment therefore. There is no debt actually created in this transaction, right? You're not actually deferring the payment of a debt. It's simply a factoring transaction. The supplier, it's selling its right to collect from the buyer to the supply chain finance company in exchange for a discount. There's no new debtor-creditor relationship created by between the parties, and no payment obligation is deferred, right? Really, when you think about this, it's just a normal factoring transaction. It's just that the supply chain finance company has this pre-existing relationship with the account debtor. So when you're a factor, you're always worried about not necessarily the creditworthiness of the seller of the account. You're worried about the creditworthiness of the account debtor, right? The person that the widgets were sold to. So here, if it's Walmart or some other company that has good credit, your supply chain finance company is really working directly with that company for lots of different suppliers. So it's a lower credit risk. And there really is no credit relationship that's created between the supply chain finance company and the um, supplier. Now, I've got a second question, and I think this one's a little tougher, but I want to get your thoughts on it. So here we're looking at the other side of the transaction, right? Here we got the buyer. Let's say it's Walmart, and the supply chain finance company. Let's say it's let's just say it's Acme Supply Chain Finance Company. So as you recall, the buyer will submit that invoice to the finance company, and then under normal circumstances, what's going to happen is that the supply chain finance company is going to repay the buyer. The buyer is going to repay the supply chain finance company at net 60, right, at the normal date of the invoice. But let's say that the buyer also has cash flow needs. Let's say it's not Walmart. Let's say it's a little smaller than Walmart. Maybe we need some cash. So the supply chain finance company says, okay, we will pay this. We'll pay your supplier, but also in exchange for a fee, you can pay us on net 60 plus another 30 days in exchange for a fee. Okay, so the buyer gets a little extra time too to pay. Is that a 1071 credit transaction? And I'll give us a little bit more time. All right, 5, 4, 3, 2, 1. I wish I had the Jeopardy theme. That would be much more entertaining. All right.
I agree.
I think most people, I think most people got it right. I think it's probably closer to yes. At the point at which the supply chain finance company gives the buyer extra time, a debtor-creditor relationship has arguably been created, and the supply chain finance company is deferring the payment of that debt in exchange for a fee. Now, note that if there is no fee, the transaction could be excluded as incidental finance, which we'll quickly talk about here in a second, based on the terms of the agreement, right? There are other exclusions that it could fall into if there is no fee. But I do think that if you have this type of arrangement, it probably is a 1071 transaction. So the bottom line, in the factoring supply chain finance space, there's a ton of variation in products, and it's not enough to just say factoring is excluded. You need to carefully review your product lines, and you need to have a CMS in place to ensure that you're reviewing future product offerings for possible compliance obligations. So Alex, let's talk about leasing, because that's hard too.
Yeah, let's do. Before we do that, in typical me fashion, I'm going rogue for a second. And given that I've not talked to anybody about this, you all may object, but I just grabbed like 2 quick questions that I can super quickly answer from our Q&A section about earlier. I'm going to clarify those really quickly, and then I'm going to breeze through true leases. Cindy just asked a quick question about whether small business includes nonprofit organizations. They're excluded from the definition of small business. Nate asked a similar question about whether you're required to collect data points only for applicants with gross annual revenue below 5 million. Again, if a business has, that's correct. If a business has more than 5 million in gross annual revenue for its preceding fiscal year, it is not a small business pursuant to the final rule. And then the last one I'm going to do really quickly is a question from Lynn, who said, so if there's 10 owners who each own 10%, i.e. no principal owner, then the business cannot be classified as women-owned or minority-owned, because that would be determined based on principal owners. And there would not be any principal owners in this example. So just really quickly, principal owner is not necessarily going to come into play in that determination. So to determine whether they're minority-owned, you're looking at 1, the collective ownership or control of the business, and 2, whether more than 50% of the net profits or losses accrue to one or more of those minority individuals or women. I know that's a really quick, just addressing those quick questions, and I know that there are more, but I wanted to address some before we moved on, since we're running short on time. So yes, the exclusion of true leases. Specifically, the rule says that a covered credit transaction does not include a transfer from one business to another of the right to possession and use of goods for a term in return for consideration. Now, this true lease exemption can be a bit tricky in times. And a lot of times I see this come into play the most with equipment leasing. And in that industry in particular, I've seen a lot of folks who are wary of relying on this exemption alone, because in equipment leasing, and just to give you all kind of an example of where this might come into play, a lot of times they'll use equipment leasing as sort of an alternative for equipment financing, because it doesn't require a large down payment. If I've learned anything about the alternative commercial finance industry, it's that they will tailor their business model to make sure that the small to medium businesses are getting what they need. Like, I love how adaptable this industry is. But this is a really tricky exemption, and this example really tells you why. So example one, lender provides equipment financing to a company. Pursuant to the terms of the transaction, the lender provides the funds to purchase equipment, and the company may use the equipment for a period of 7 years. At the end of this 7-year period, the company has the option to purchase or otherwise become the owner of the equipment for $1. This transaction is not a true lease for purposes of the final rule, because it results in the creation of a security interest by permitting the company to become the owner of the equipment for nominal additional consideration. But what about a rental, let's say rental purchase option, where the lessee has the option to purchase the goods at fair market value? So again, this is a situation where the 1071 preamble is not really clear, but it does draw on the UCC's distinction between the creation of a lease and a security interest. And the UCC says that a lease does not become a security interest if, among other things, the lessee has the option to basically purchase those goods for the fair market value. There are obviously, what is the reasonably predicted fair market value? Really, a lot of whether your true leases are going to fall under this exemption depend on the lessor's residual position. And again, we're so short on time, I'm going to sort of breeze past that. But if you are dealing with true leases, or you think you might want to claim this exemption, please reach out to us if you have any questions or would like to discuss further.
Yeah, and I'll add to this. One thing that I've seen a lot of in the lease area is that you have that lease, and it's unclear whether or not it's a true lease or a disguised security interest. And the UCC does speak to that, but it's a complicated issue. You don't have to stop there, right? You can apply other exemptions. And one thing I see a lot of is that, okay, well, it may or may not be a true lease. It's not clear. However, we're keeping that lease on our books. We're not selling the interest in the lease. So arguably it's a trade credit, which Alex is going to talk about here in a second. So you can layer some of these exemptions. You just have to think very carefully about how you're going about doing it and how you're documenting it.
Right. So just to get in, again, I'm going to touch on these really quickly. If you have questions, reach out. Other exclusions include trade credit, and that's a financing arrangement, where a business acquires goods or services from another business without paying immediately. That's not going to be considered a covered transaction. One note is that a trade credit exclusion does not extend to affiliates and facilitators of trade creditors that provide financing, even if only for the trade creditors' products. Sorry, y'all. Once I activate that talk fast mode, which I did for the questions, it's like a switch. It's very hard for me to shut it off. Some of the other exemptions, HMDA reportable transactions. That's just basically if you're dealing with a transaction that you already have to report under HMDA, obviously you don't need to re-report it under 1071. Insurance premium financing. It's just a way for small businesses to obtain insurance coverage without having to make large upfront premium payments. Sort of the basis for this exclusion was that it's already governed quite extensively by the states, and some of those state laws actually prohibit the type of data collection that 1071 would require. Public utilities credit, I don't think that's something that you all are going to be dealing with. Securities credit, again, largely regulated by the Securities Exchange Act. And incidental credit. And it's important to note about incidental credit that that's credit that's not made under a credit card account, not subject to a finance charge, and not payable by agreement in more than 4 transactions.
Yeah. And one more thing I'll add just about trade credit before we go over to Leslie is to keep in mind, if you have a financing arm, right? If you are a heavy equipment dealer and you have a separate entity that's a financing arm, what the trade credit exemption is saying, and that's that second footnote, or excuse me, second bullet, is that it's not going to extend. This exemption does not apply if you are, if your financing arm is actually originating the credit, right? You can't say, well, it's all under one kind of parent. and therefore it's trade credit because it's staying on the books. So if you do have a separate financing arm, you need to spend some time thinking about how that financing arm is constituted from a kind of a corporate perspective to understand whether or not it's a separate entity, because if it is, you very well could be subject to 1071. So Leslie,
I think this might be mine.
Oh, I'm sorry. Yep, go ahead.
Yeah, but I'm going to do this really quickly. These are just the compliance dates. And to everyone, because obviously I don't think we're going to have really time for a lot of these questions. We're going to talk to our team and see if there's a way that we can kind of compile and answer these questions we send out. I'm going to see what we can do about getting these answered for everyone. But here, the original compliance dates are here in this first row. Don't panic. They have been extended. And your compliance date is really determined based on a tiered basis. So in order to determine what your tier is going to be, you can use your small business originations from 2022 and 2023 to determine your initial compliance date, or you have the option to use your covered transactions from 2023 and 2024. So tier one, you're going to be tier one if you have at least 2,500 covered transactions. If you have at least 500, you're going to be in tier two. And if you have at least 100 covered transactions, you're going to fall into tier three. So again, I know I'm really breezing through this, but based on the tier, you're going to see your new compliance date here. And recall from earlier, we discussed that your data has to be submitted to the CFPB by June 1st each year. So in this third row here, you're going to see, again, based on your tier, what your first filing deadline is going to be. And the quick takeaway here is that you've at least got to have some sort of understanding of which of your transactions are indeed covered transactions in order to even identify your compliance deadline. So if you're unaware, now is really the time to start seeing about that. And now we're kicking it over to Leslie.
Well, thanks, Alex. So as we've kind of already talked about a little bit and alluded to and scared you about, reporting under Section 1071 is going to give regulators a lot of detailed information about your company and about your small business loan activity and portfolio. It's also going to give that information to the public. So coverage by this rule really increases your regulatory risk, your litigation risk, and your reputational risk, both in terms of just not complying with the rule, getting inaccurate data, not collecting the data, not forgetting to report certain applications, et cetera. So getting all these things wrong that Chris talked about earlier about whether you're covered or not, those have some risk to it, as well as with what the data you do report says about you. There's a lot of risk there. And I would say probably the most significant part of the risk is there. And especially if your data is not good. Because everyone is going to see this data. And so you want it to be accurate. So the one express purpose of Section 1071, the law itself, so the statute Congress passed, and the rule is the purpose of this is to facilitate enforcement of fair lending laws. So that is exactly what they're trying to do here, and you need to keep that in mind with every step of this. We expect the CFPB to be watching lenders' compliance in this space very, very carefully. This is the first one of its kind. And while we've done HMDA before, we haven't done it in this context before. And while tripping up here could, of course, lead to public consent orders and other state regulatory scrutiny, the litigation and reputation risk associated with the fair lending data cannot be understated. We've seen this so much over the years for HMDA, and as Alex alluded to, it doesn't just even require an actual fair lending consent order with the CFPB. You could just have CNN make an online article about it. And there you go. Now you are subject to multiple lawsuits. You have to go talk to Congress. There's a lot going on. So this really can't be understated. The data is reported publicly for anyone to review. Nonprofits, fair lending nonprofits, plaintiffs' attorneys, they're all waiting for this data release. they are going to be reviewing it and scrutinizing it and manipulating it in every way possible to see where they see some opportunities. And so are those news reporters. So watch out for the media. And they have, most of these folks have already learned how to do this with HMDA data. They know how to manipulate it. They can hire a vendor to do it and come up with answers very quickly. Now you have to remember the data that is released publicly is trimmed. So it for privacy reasons, they don't release every detail that you have and that you report. And so, you do have an opportunity there to know what is in your data and to mitigate that risk. But sometimes, it's out there, and you need to be sure to make it as accurate as possible so it accurately wrecks your company, because this could have huge reputational risks, which would include things like just a loss of customer trust and satisfaction, damage to your brand. You'll have difficulty recruiting people who don't want to be part of your company because you discriminate in your lending. It just doesn't sound good. You get the loss of trust of stakeholders, and then overall just increased regulatory scrutiny from all areas. And just so we're running out of time, I think it's about time to tell you a few good things here. Because if you only take one thing away from this webinar, other than Chris's one thing on factoring, I hope that this is it, which is while the cost to implement and to get this right is really, really high, I'm not going to lie to you, the cost of bad data is completely disastrous. So this takes a lot of work, but I say, take it seriously, reach out to consultants, to vendors, to outside counsel for help, and just get in front of this. Preparation is really the critical key here. You want to have this compliant management system that we've talked about a few times, mentioned before, detailed policies and procedures and guides. You want to make sure all of your employees, your vendors, everyone from the top down understand what they need to do and how important it is. They need to understand the risk. There need to be controls and monitoring in place because people make mistakes. And you really just need to ensure that you're training and testing and retesting. This is all before you even start reporting, because if you look at the delay that's in this rule, you could, once we get past the compliance initial enforcement date or application dates, you're going to start collecting January, and you're not going to report until a year and a half later. And then the CFPB will be taking that data and massaging it a little bit, taking out all the things that they need for privacy purposes, and then they'll publicly disclose it. And then the people that are receiving that data will need to look at it. So we're probably talking 2 years before this data gets analyzed. That means if you have an error or more in your data, something bad, a bad practice in your data, that's not going to be spotted for 2 years. And now you have 2 years worth of loan transactions and applications that have that error in it. And it's just now being identified. You want to get in front of that. You want to try to test that data and know the story that it tells about you before you're reporting, way before you're reporting. And so because it looks like we're really out of time, I will cut it short right here. Yeah. Unless Chris, you or Alex have anything else.
No, thank you all for being here. I did want to let everyone know we have an alternative commercial, that should be alternative commercial financial services mailing list. We do a weekly alternative commercial finance update where we talk about legal issues affecting the alternative commercial finance space, factors, fintechs in the small business lending space, and others who do that type of product. If you scan this, you'll be added. You get to a form where you can be added to the mailing list. We'd love to have you as part of that. And then, like Alex said, we're going to do our best to reach out to folks who asked questions. And if you have other questions, please do not hesitate to reach out to any one of us. We'd love to chat with you about 1071 or really anything else. So thank you all for being here. We will have, I believe, a copy of the video and the deck available by link. So if you have that, just feel free to if you want that, please feel free to reach out, and we'll make sure that you get that. And hope you have a wonderful rest of the day and a wonderful weekend coming up.
Thanks, everyone.